The silver market just broke, not in some dramatic Hollywood kind of way, not with alarms going off or people running through the streets. It broke quietly, with a policy update from the Shanghai Futures Exchange that most people will never even hear about. But if you understand what it means, it changes everything. Starting the last day of February, if you don't have a hedging quota, you get zero delivery allocation. Zero. Let that sink in. One of the largest futures exchanges on the planet just openly admitted that there is not enough physical silver to go around. And while the West sleeps through this, a $297 billion market shift is already underway. This isn't about charts or speculation. This is financial warfare, and it's being fought not with tanks or missiles, but with ounces of metal. Let me walk you through exactly what's happening, piece by piece, because the numbers here don't lie. Let's start with the hard data coming out of Shanghai, because this is where the cracks are impossible to ignore. Right now, silver in the West is trading at roughly $85.90. Over in Shanghai, that same silver is trading above $92. That's a $7 premium. Now, in a normal functioning market, that gap would disappear almost instantly. Think of it like this. Imagine there's a burger joint on one side of the street selling burgers for $5, and directly across the street, the same burger is going for $12. What happens? Everyone rushes to buy the cheap burger and sell it across the street. Within minutes, the prices equalize. That's how arbitrage works. It's one of the most basic forces in any market. Traders buy where it's cheap, sell where it's expensive, and the gap closes. But that's not happening here. The gap isn't closing. And there's only one reason a price gap like this persists in a globally connected market. The physical silver is either stuck or it's gone. In just 12 hours, that price surged 8%, adding roughly $300 billion in market cap. And the exchange's response tells you everything you need to know. In a single week, the Shanghai Futures Exchange suspended 20 account groups. 20. Think about that. That's like a casino walking up to its highest rollers, the people spending the most money, and physically escorting them out the door. Not because they broke the rules, but because the house is running out of chips. They're protecting what little inventory they have left. Now, technically, Article 16 of the exchange's regulations allows them to do this. It's on the books. But it has almost never been used this aggressively. When an exchange starts kicking people out to protect supply, that's not regulation. That's desperation. Now let's look at what's happening on the western side of this equation, because COMEX, the primary futures exchange in the United States, is telling its own version of this story. Recently, 861,000 ounces of silver walked out of the vault in a single day. At the same time, March contracts are either closing out or rolling over to future months at a frantic pace. Traders are scrambling. And here's the math that should keep you up at night. The open interest on COMEX, meaning the total number of paper bets outstanding, sits at roughly 340 million ounces. The actual registered silver sitting in the vaults, the metal that's available for delivery, is about 101 million ounces. That's a ratio of more than 4 to 1. 4 paper claims for every single real ounce. Let me give you an analogy that makes this crystal clear. Imagine you're at a fancy restaurant and you hand your keys to the valet, but so do 3 other people. And all 4 of you were told your car is parked and ready. When dinner ends and everyone walks outside at the same time, only one person is driving home. The other 3 are standing on the curb holding a little paper ticket that suddenly means nothing. That is what's happening in the silver market right now. There are 4 people holding a claim on the same ounce of metal, and the moment everyone demands delivery at once, 3 of them walk away empty-handed. And this isn't just fringe analysts sounding the alarm. The mainstream is starting to confirm what's been building for years. Bloomberg, during the Lunar New Year period, ran a report noting that retail buyers were aggressively purchasing bars and coins. But buried in that same report was an admission that supply constraints are raising real concerns. That's Bloomberg. Not some newsletter, not some guy on the internet. Bloomberg. Analyst David Jensen has been tracking this for some time, and his data shows that global vault depletion is happening everywhere. Not just in New York, not just in London, everywhere. Meanwhile, lease rates for silver are skyrocketing. Now, lease rates are essentially the cost of borrowing physical metal. When those rates spike, it means there's no metal available to borrow. Lenders are either hoarding what they have or there simply isn't enough to lend out. And none of this happened overnight. This is the result of decades of overconsumption and underproduction. The world has been pulling silver out of the ground and burning through it faster than it can be replaced for years. The stockpiles that once acted as a cushion are now running on fumes. What you're seeing in the price action right now, the volatility, the sudden spikes, those aren't the main event. Those are the tremors before the earthquake. When a real supply shock hits, and at this rate it's a matter of when, not if, prices have to go higher. They have to. Because the only way to pull new silver out of the ground is to make it economically worthwhile for miners to do it, and that requires significantly higher prices. Now let's zoom out, because none of this is happening in a vacuum. There's a geopolitical chess game playing out underneath all of it. China's imports from the United States have hit a 26-year low. Think about that timeline. 26 years. China has been quietly cutting the cord for the last 5 years. It's like a messy divorce, where one side thought tariffs would force the other to come crawling back, and instead, the other side just moved on entirely. China rerouted its supply chains. It started hoarding strategic metals. It implemented export controls on critical materials. And now, when it comes to pricing silver, the East is placing a higher value on physical metal than the West places on its paper contracts. That $7 premium out of Shanghai isn't random. It's a statement. And here's something that doesn't get talked about nearly enough. The ratio between gold and silver economically is roughly 100 ounces of silver for every 1 ounce of gold. Yet silver is treated like it's common, like it's just some industrial metal you don't need to think about. But it's not common at all. In fact, by certain measures, it's becoming rarer than gold in terms of accessible above-ground supply. And unlike gold, which mostly sits in vaults and jewelry looking pretty, silver gets used up. It gets consumed. It goes into solar panels and never comes back. It goes into electric vehicles and never comes back. It goes into the AI data centers that are being built at breakneck speed right now, and it never comes back. Every single one of those industries is growing. Every single one of them needs more silver, and the supply just isn't there to meet it. Meanwhile, the signals coming out of the big banks are about as contradictory as they've ever been, and that contradiction itself tells a story. Bank of America recently added U.S. materials to its bubble watch list. Their warning is that artificial intelligence and innovation are creating unstable, overheated market conditions. That's a sell signal dressed up in fancy language. At the same time, Wells Fargo set a gold price target above $3,000, which represents roughly 20% upside from recent levels. Their take on the recent pullback in gold prices is that it's a healthy correction and a buying opportunity. So one major bank is saying the market is in a bubble, and another is saying buy the dip in precious metals. How do you read that? Here's how I read it. Over the last 25 years, the S&P 500, the benchmark for American stocks, has underperformed gold by 60%. Let that sit for a second. A rock pulled out of the ground has outperformed the 500 biggest companies in the United States over a quarter century. That tells you something fundamental about what's happening to the dollar. The implication is pretty straightforward. The dollar is breaking. And the real bubble might not be in metals at all. The real bubble might be in the paper assets everyone has been told are safe. Now, I want to be fair here, because there are legitimate bearish arguments and they deserve to be heard. Silver is volatile. 4 to 6% daily moves are not unusual, and that kind of volatility can shake people out of positions fast. The spike in lease rates could turn out to be a temporary glitch, not a structural crisis. COMEX could very well meet its March delivery obligations and prove the doomsayers wrong, at least for now. And we've seen this before. People have been calling for the end of the paper silver market for years, and so far, the system has found ways to keep going. Premiums like the one out of Shanghai have been seen at elevated levels in the past. Prices can and do crash. And markets, as the old saying goes, can stay irrational longer than you can stay solvent. All of that is true. All of that is worth keeping in mind. But here's the thing about the boy who cried wolf. In the actual story, the wolf eventually shows up. Let's talk about the manipulation side of this, because it's not theory. It's documented fact. The paper silver market has been used to suppress prices through the creation of essentially infinite contracts and derivatives. And if you think that sounds like a conspiracy, remember that JP Morgan paid a $920 million settlement for manipulating precious metals markets. They admitted to it. They paid the fine. And then they kept doing it, because at that scale, the fine is just a cost of doing business. It's a parking ticket on a Lamborghini. But here's the limit of that game. You can print as many paper contracts as you want. You can create derivatives on top of derivatives on top of derivatives. What you cannot do is print physical metal. The game ends the moment enough people stand for delivery and demand the real thing. And look at what's happening right now. Shanghai is restricting deliveries at the end of February. Global vaults are depleting. 20 account groups suspended in a single week. Bloomberg is admitting supply constraints. The signals are converging. Analyst Daniel Oliver has laid out the math on where gold is headed, projecting it to $2,500 and beyond, because the dollar is trapped. The U.S. either defaults on its obligations or it prints trillions more dollars to cover them. Either path leads to higher metal prices. And silver has something gold doesn't. Silver carries both monetary demand and industrial demand. It's wanted as money and it's needed for solar panels, electric vehicles, and artificial intelligence infrastructure. Gold sits in a vault. Silver gets consumed by the future. Let's look at the scoreboard one more time because I want these numbers burned into your memory. COMEX has 101 million ounces of real registered silver. Against that, there are 340 million ounces of paper claims. That's more than a 3-to-1 shortfall the moment the music stops and everyone wants their chair. And there's a pattern that's been repeating over and over. Asian markets buy overnight, prices go up. Then New York opens in the morning, paper contracts flood the market, and prices get pushed back down. That's been the playbook for years. But it's starting to break. The Shanghai premium is holding. It's not getting arbitraged away. The East is paying a premium for physical metal and simply ignoring what the New York screen says. When buyers with deep pockets stop caring about the paper price and start paying whatever it takes for the real thing, the paper market loses its grip. And that's exactly what we're watching unfold. So here's what I want you to do. Don't take my word for any of this. Go verify it yourself. Pull up the Shanghai Futures Exchange announcement. Look at the COMEX Vault reports. Read the Bloomberg article about Hong Kong demand during Lunar New Year. The data is public, the math is simple, and the math screams. You can ignore the headlines. You can scroll past this and go on with your day. Or you can check the numbers. Because wealth transfers don't happen with a warning bell. They happen while the majority is asleep, and by the time most people notice, the move has already been made. Shanghai just showed its hand. The desperation is out in the open for anyone willing to look. And there's one more piece of this puzzle I haven't touched yet. There's an accounting trick the banks have been using to make their vaults look full when they're not. I break that down completely in the video linked right here. Click it, because once you see how that works, the whole picture snaps into focus.